Hey guys, Adrian here, your local real estate professional. In today's video, I'm going to be talking about PMI or private mortgage insurance. Is it a good thing? Is it a bad thing? And in general, what can you do to avoid it, or should you avoid it altogether at all? I'm also joined today by my assistant here, Ellie. She's a little sleepy, but she'll be here to hopefully keep me in check and make sure I'm giving you guys the right information. So without further ado, let's get started. So the first thing that I want to talk about today is what is PMI? PMI stands for Private Mortgage Insurance. For those of us who haven't saved 20% down for a new home, we typically put about 3 to 3.5% depending on the loan program, whether you go FHA or whether you go conventional. Because we're not putting 20% down, a lot of lenders will put a fee on your mortgage payment of between $150 to $300 or $400 depending on the value of the house. So that extra $150 to $400 is called private mortgage insurance. Now, if there's any reason the homeowner doesn't make the mortgage payments for the next 2 to 3 months, private mortgage insurance will kick in, at which point the lender takes possession of the home and sells it at a foreclosure sale. Can you avoid PMI? Well, yeah, I spoke about it earlier. You can make a 20% down payment, at which point your loan to value is 80% of the value of the house, and you won't be charged PMI for the life of the loan. Most of us will probably save the necessary amount for 20% in 10 years, maybe even a little bit less. So it's more prudent, or it's a little easier to save up that 3.5% or 3% depending on your financial situation. Now, what is the difference between MMI and PMI? MMI is the same thing as PMI, except it's only for FHA loans, Federal Housing Administration loans. So those loans are government insured, and that MMI is there for the life of the loan. So let's say you put that 3.5% down payment, you build up to 20% equity, you call the servicing bank and you tell them, hey, I've saved up 20% equity, or I now have 20% equity, can I get rid of MMI? That servicing bank will tell you no, because it's an FHA loan. You would have to refinance into another loan program to get rid of MMI. If you were to go conventional, that is PMI or private mortgage insurance. Once you save up that 20% equity, or once you build up to 20% equity, you can then call the servicing bank and tell them, hey, I'm at that point, I want to remove PMI, and for a small fee or a small admin fee, they'll remove it for you, and you now have between $150 to $400. So that's PMI in a nutshell. The second point I'm going to bring up today is PMI good for you? Now, if you're like me, I don't like spending unnecessarily. If I have to pay a little extra, it really turns me off to whatever it is I'm about to buy, or if it's a service. I don't like it. So PMI, for me personally, is something that I don't like either. I recently read an article that kind of changed my perspective on PMI, if you will. So that article taught me to look at PMI as more of an investment, something that I'm putting money towards to get a return on. So I'm going to read a little something that I found online, so bear with me here for a second. According to the government lending agency FHFA, or Federal Housing Financial Administration, home values are up more than 140% since 1991. That means a home worth $100,000 in January of 1991 is worth $240,000 today. I created a little analogy or a little whiteboard video that I'm going to play right now to kind of break it down a little bit easier, because it's kind of a heady topic and I feel like I'm not doing it justice at the moment, but here it is, and I hope it makes sense to you guys. So in this whiteboard video, there are two versions of you, version A and version B. This is year one, you found a house at $233,000. Version A of you hit the ground running. You made a 5% down payment and you're going to be paying $135 a month in PMI, while version B of you is going to save for that 20% down payment. Let's fast forward to year 5. That same house is now worth $276,000. Version B of you is now ready to meet that 20% down payment, but you are now paying 18% more for that same house than you would have 5 years ago. Version A of you spent $8,100 in PMI payments in those 5 years, but your home is now worth $43,000 more than when you bought it. That $8,100 in PMI payments equates to about a 500% return on investment, if we look at it as an investment. On top of that, you can now call your servicing lender and let them know, hey, I am now at 20% equity and I'd like to remove my PMI payments. So in conclusion, the question about whether PMI is beneficial, is it worth it to pay 3.5% down now and suffer through PMI, or wait till you build up that 20% equity and risk having to pay more for the same style or size of house, is really up to you. I'm not trying to change your mind on it. I'm not trying to convince you to buy now or later. What I'm trying to do is change your perspective on PMI so you don't think of it as just a waste of money. Whether you still do or not, I mean, it's entirely up to you, it's your prerogative. But it is good to know that PMI is there to help you get into a home sooner rather than later. It's not just a waste of money. It may seem like it may feel like it sometimes, but when you look at it as a return on investment, it's definitely something worth checking out. So if you have any questions, I would highly recommend reaching out to me. I would be happy to answer any of them. If you have any ideas on new topics or questions or videos that I should probably post next, I'm open to any recommendations or suggestions. I would actually love to hear some of your feedback on that. If you liked today's video, please give me a like or share. I would really appreciate that. If you're thinking about buying or selling a home anytime soon, give me a call. I would love to help you out, give you a free consultation. Again, my name is Adrian, your local real estate professional, and I'll see you guys in the next one.